On this month's market update, we're going to get into the specific statistics of the South Bay of Los Angeles housing market, what's going on there, as well as what's going on nationally in terms of homeowners equity, as well as interest rates, what's going on with theirs, where we expect them to go, and then also how that might affect you, the homeowner here in the South Bay. Last month, we had closed sales, new listings, and pending sales. They're all down across the board. And I'm talking 5 to 10% down. So not a huge amount, but in general, we have less closings, we have less new listings, and less pending sales. This is kind of expected. This time of year, September, October, November, we see listings and all of these numbers start to decrease yearly normally. However, it's a little extra early this year due to the election. In election years, we usually see interest rates come down nationally, but in terms of our local market here in the South Bay, we also see buyer and seller interest in making a move decrease the few months leading up to the election. I, for one, have had multiple conversations with folks that have said, let's wait and see what happens in November, as something that they've said to me on the phone or in person. So that hasn't really affected our month supply. We're still at 3.2 months in terms of month supply. So if we had no more listings come out tomorrow, then that just means that it'll take only just over 3 months for the current buyer's demand to buy up all the listings out there. So that's still a seller's market. It's still a low inventory environment. And I know you've been feeling that, buyers out there. If you've been looking for properties, there's not much to choose from. The average days on market is 25 and the median days on market is 13. Those are both down from the highs of a few months ago, but remaining relatively steady. At our highest, we had an average days on market of about 40. We're at 25. Then at our highest, we had a median days on market about 15, 16 days. We're still only at 13 days. So nothing's changing there. That's all telling the same story, right? We might have less listings come in the market, but we also might have a little less demand. And then that means those numbers will remain relatively stable. The percentage of list price sold, which means if I list a home at $1 million, what percentage of that actually does it close at, is almost at 100%. It's at 99%. And we've been kind of hanging out on this 100% line for a year now, a little bit over 100%, at 100%, or a little bit beneath. Just in general, if homes are priced right, they're selling. Some are selling over list price and others selling under. On average, they're selling at right around 100%. The average sale price last year this time was actually larger than the average sale price at this year this time. $1,578,000 last year and $1,524,000 this year. So you can see here in our month over month price graph that in about August of last year, we had this little peak month here. And then in August of this year, you can see we definitely went down and we dipped a significant amount. But if you took the average of that line and went from July, August last year to July, August this year, that line is still appreciating. And we expect this number to come back. I don't expect this graph to continue to go down over next month and the month after the month after. If that happens, we'll definitely report on it, but I would expect this graph to come right back next month and just continue this steady line moving forwards. So let's take a look at what's going on nationally. Home value, equity, and debt in the trillions. And you can see here, this is a line of owner's equity, home mortgage liability, and real estate value. Obviously, what you owe plus your equity equals the value in real estate. And you can see here in 2008, 9, 10, in those years, we had a situation where homeowners owed more than the home was worth. Therefore, we had a lot of short sales. They couldn't sell and pay the bank back and make any more money. But since then, we've seen significant increases in this value. We have the largest homeowners equity in the history of the United States right now. And that's mainly because most folks have been super conservative with their homes over the past 10 years because of what happened in 2008 and 9 and 10. So there's been less refinances, less HELOCs, less equity taken out to do things to properties, to buy other properties. Therefore, homeowners have larger safe haven in terms of equity than they've ever had here in the United States. And you can see that here on this graph as well. Americans sitting on tremendous equity. Over 2/3 of Americans nationwide have paid off their mortgage and have at least 50% equity. So I'm having a lot of conversations, especially over the last couple of years, about capital gains and what happens if you sell with all this equity. What is your tax shelter? Where's the best places to put this money? We've had all those discussions with clients over the last few years, because 2/3 of them have paid off their mortgage or have at least 50% equity. If you're talking about a $2 million home, that's $1 million in equity at least. Some of them paid off here in the South Bay of Los Angeles. So it's pretty cool. And that also means safety. The market is very safe right now. Homeowners are very safe. Market could take a 30% drop, and 2/3 of homeowners would be okay in that scenario. Now, I don't expect that to happen, obviously, but just saying that is why the market seems very safe. That plus the demand side of things. So how are interest rates looking right now? Well, obviously, we've been in a high interest rate environment since about mid-2022, where they just kind of kept stacking on interest rates, stacking. But now, finally, rates seem to be coming down. Fed Chair Powell signals time has come for a September rate cut. Jerome H. Powell used a speech in Jackson Hole to signal the Federal Reserve will begin to cut rates on September 18th to voice wariness about the job market. Well, generally speaking, inflation is the enemy of rates. Inflation has been very, very high, and now inflation is calming down and rates are coming back. Also, we've had very good jobs reports. Very good jobs reports also hamper rates. If we have really, really good jobs reports and low unemployment, rates are generally high. As we have a little bit more unemployment, rates generally come down. We'll take a look at this next graph. Inflation. So inflation in 2022 in March was a 5.3%. And that's when they're like, whoa, we need to raise rates. So they raise rates, and they've gotten inflation under control. It's not at the target level yet, but it seems to be trending that way, which is why the Fed is like, okay, now it's time to start changing things. And if you've been noticing, 5-6 months ago, we were approaching 8 in terms of interest rates. 7.5 was where we were sitting most of the time. And now if you looked a couple days ago, we're at 6.27. I think today we're at 6.11 in rates. We're getting down towards those 5s. The downward pressure is happening. Same thing you can see here in unemployment. Unemployment rates are rising, but still below the average. So unemployment rates rising, inflation coming down means interest rates will decrease. And that's why everybody expects interest rates to continue to decrease. Nearly 80% of economists surveyed by Bloomberg recently predicted the Fed will make a quarter point decrease to a range of 5% to 5.25% in September. So that's the federal funds rate. That's not the interest rate that consumers see. But the point is, a full quarter of a point, they're expecting the rates to come down in terms of the basis of what consumers see in an interest rate. Generally, the rate cutting cycle is not one and done. 6 to 8 rounds of rate cuts all through 2025 look likely, according to Lawrence Yun, the chief economist at NAR. If you know what NAR is, the National Association of Realtors. This is some high quality projections in terms of interest rates. 30-year fixed rate. These are the dotted line graphs of where Fannie Mae, the MBA, the NAR, and Wells Fargo forecast all expect mortgage rates to go. And you can see in general, they expect them to decrease moving forward throughout quarter 1, quarter 2, quarter 3, and quarter 4 of 2025. Now, you may be thinking, well, obviously that means Garrison wants you to sell now or buy now or do something now because interest rates are coming down. And that's not exactly what I'm saying. The right time to buy or the right time to sell is all person dependent. Trying to time the market is difficult. There's actually a great quote on this. Timing the market is basically impossible if you're always waiting for a perfect market. You're going to be waiting forever. Buy now if it's only a good idea for you. I think that's a fair assessment because in general, I had many folks in 2016, 17, 18, 19 tell me they're waiting for prices to come down to buy. Okay. And then in 2020 and 21, when interest rates were the lowest they'd ever been and it was the most affordable time to buy, even though prices were high, they're waiting for the market to get less crazy. Okay. And then in 2022, the interest rates go up and the market gets less crazy and prices start coming down. Then those same people are telling me, oh, well, interest rates are too high. And then now we've got this appreciating market and interest rates are coming under control. It's always something. It all works together. There's no perfect market. It doesn't exist. There was a little bit of a drop in late 2022, but that's gone. And now the question is, what do you expect will happen? If interest rates get back down into the 5s, 5.5, 5.25 maybe, Do you think that at that point, many home buyers are going to come back into the market and we might see a big flood of property buying again? Do you think at a certain point, at what point do you think that sellers will start to sell their first house to buy their next house? Because that second home, that selling the first one to buy the next one, that's been the market that's been hurt the most here in the South Bay. Entry-level markets, folks have been still buying at high rates. However, it's the ones where they have to sell their first home have been kind of pausing because it's such a big gap between what they're currently paying at 3% and what they will pay on the next house. So at what point do they jump back in the market? And when they do, by the way, that's 1 and 1 on each side, right? That's a seller on their first property and a buyer on the second property. And then also we still have first-time buyers coming in. So there's probably 2 markets happening here, and depending on what you want to do, the first one is this transitionary market until everybody goes wild. And by the way, everybody's going to go wild on the same day. It's the weird thing. It'll happen. Some market report will come out. Interest rates will hit a magical number of 5 point something, and everybody will decide to buy again. Until that day, we'll be in this transitionary phase where interest rates are coming down, and some folks will stay on the sidelines being like, hey, I'll wait for something lower. And same thing with some sellers will stay on the sidelines and be like, hey, I won't sell until the interest rates come lower. And it'll be a normal market. The interest rates will be a bit higher, but if you happen to enter that market, you'll have less competition and you'll be able to sell at a good price because most homes have been selling at a good price over the last couple of years in high interest rate markets. And then you'll be able to find your next home and not have to beat off 20 other people trying to offer on the same property as well. So if that's what you think you would like in terms of your strategy in buying, then cool. Then if interest rates continue to decrease and you see some low 5s, and maybe even to the 4s, who knows, then you can always refinance. You already own the property. Or you can choose till you think that interest rates have hit their lowest point. And if that case happens, then when you enter the market, you're going to enter the market with everybody else. And there's going to be a hot buying market of everybody trying to get the property they can get at the lowest possible monthly rate. Obviously, prices will be skyrocketing at that point because if 1 million people come into the market at the same time and try to all buy the same properties, obviously prices are going to go up really fast. So you can do that, and then you'll have a really easy time selling your place. Your home will go for $1 billion, but also you'll have a really hard time buying. It'll be a lot like 2020 and 2021 again. So the question for you is, which market do you prefer? Assuming interest rates continue to come down. And by the way, I don't expect them to hit historic lowest in the history of the United States levels again. I don't expect us to hit 4s again, and nobody's predicting that. So somewhere in the 5s is where we will land. Most likely, that's what I expect. That's what most people are forecasting. So which market is right for you, homeowner here in the South Bay? Would you prefer a little bit less competition and pay a little bit more rate with the opportunity to potentially refinance in the future? Or would you prefer high competition and then both making your home go crazy and making your sale really easy, but also making your purchase a little more difficult? And that's the decision that many homeowners and purchasers here in the South Bay will have to wrestle with over the next 6 months as we continue to see these interest rates decline. So it'll be a lot of fun. I personally think there's a magical window here over the next couple months until November, because I'm having those conversations about people waiting until November. So in this magical window, I think there will be some deals to be had at some really, really nice rates comparatively to what we just did. I think it's a great time right now in these next couple months to kind of get in before the rest of the crowd does. But that's up to you. Everybody likes to do things their own way, and it's totally reasonable to do things your way. If you have any questions, I would love to be your real estate guide, and I'm happy to help. I really appreciate you watching this if you watched this far, and I will see you next time.